Hello and welcome to China Focus. I'm Shelley Zhang. Next month marks 11 years since China was allowed to join the World Trade Organization. While China's booming trade was once considered a blessing, that idea has taken a beating in recent times, especially during the U.S. presidential election. What's next for China now, and what should the U.S. do in response? Joining us on the show today is Eamonn Fingleton, a Forbes columnist and the author of In the Jaws of the Dragon, America's Fate in the Coming Era of Chinese Dominance. Thanks for joining us today.
My pleasure, Shelley.
Now, a lot of people were talking in the 80s, and you've done a lot of research on Japan's economic situation as well, but about the rising Japan, fears of that rise. Now people are talking about fears about China's rise. Do you see any similarities or differences in those two?
Well, that's a complicated question, but I was in Japan in the 1980s, and I actually predicted both the stock market crash and the real estate crash and the consequences for the banking system. But I dispute the general impression in the West that Japan is doing badly. Certainly real estate is down, stocks are down, but the thing that really interested people about Japan in the late 80s was the trade situation. And Japan's trade situation now is far stronger, even stronger than it was in the 1980s. So people are not looking at the same numbers. They're not following through on the real issue that mattered in the 1980s.
So what about the idea of kind of the fear of the rise of these powers?
Well, they are now very wealthy countries, both of them, and they're funding the U.S. Balance of payments, which means that they are accumulating basically U.S. assets, principally U.S. Treasury bonds. And the United States is becoming increasingly indebted to these countries, to both of these countries.
Now, I wanted to ask about, you mentioned trade with Japan. Now, 11 years ago, when Bill Clinton was pushing for China to enter the World Trade Organization, he was saying this was going to be a good thing for China, it was going to be a good thing for the Chinese people, it was going to be a good thing for American people and American businesses who could then, go into China and trade freely. What do you think now, 11 years later, of that?
I think on balance, it has not worked out to be a good thing for the United States. But there's a larger issue here. It's not just that made in China is the key issue, because much of what is labeled as made in China is not really made in China. It's made in Japan, it's made in Korea, it's made in Taiwan, Singapore, etc. The components, for instance, in an Apple iPhone come principally from Japan. The product comes labeled made in China, but China doesn't have the competence yet to make the really important components, the really magical components in that device. Korea is also very much ahead of China still, and Taiwan also.
So it's basically China is kind of the assembly line putting together that finished product.
For now, yes. China's rise is very palpable, very real, and it is very clear that 10, 15 years from now, it will be broadly at the level of the United States in terms of production technology.
Now, when we look at China's economy, a lot of us want to kind of look at it in the framework of the economy that we understand, which is the U.S. Are there any major kind of things that people should look at that are different about China's economic situation?
Well, China is following the Japan model, the East Asian model, which is to emphasize trade, to emphasize exports, and to minimize imports, particularly imports of consumer goods. So the basic dynamic there is to suppress consumption and increase the savings rate. Those things go together. And then you've got this sort of torrential flow of savings, which is then directed into making the workers more productive, giving them better machines, essentially, to work with. And you saw that in Japan, you saw it in Korea, Taiwan, now you're seeing it in China.
So China, the savings rate is phenomenally high. People mostly, invest in real estate, things like that. They don't really put money, there's not a lot of consumption. Now, but it seems that Chinese leaders are trying to encourage consumption. Wen Jiabao comes out and talks about how they need a domestic consumption to rise in order to kind of keep their economy going.
I think this is a half-truth. I think to some extent they are encouraging consumption. But I think that part of what's going on here is that they're playing politics for American purposes, that this is what America wants to hear, so that they say these things to sort of calm down Washington, basically.
So if you're saying they're not really looking to increase domestic consumption, and you said, they don't really want more imports, then for all these American businesses that thought, okay, the Chinese market is the place to be, is that bad news for them?
I think gradually China will increase its consumption, and that process is already in train. But I think that certainly politics is the key thing here. That they want to convince Washington that China is becoming sort of American in its approach to things, and that's not true.
So if China is not becoming American, what are they doing?
They are emphasizing investment in manufacturing. They are, as much as possible, trying to acquire other countries' technologies, production technologies particularly, and they do that by having a trade relationship that's unbalanced, so that, for instance, if you're GE in the United States and you want to sell into China and you have some very important aerospace technologies, which GE does, Beijing says, fine, we'd love to do that. We'd love to buy your stuff, but first you must invest in China and bring your most advanced production technologies to us. And basically, from GE's point of view, this is not such a bad deal because it can produce in China and sell back into the United States. Whereas if it produces in the United States and sells into China, it will be blocked in China. So from a profit-making point of view for GE, it makes sense to acquiesce in the deal it's getting in China.
Is there any risk in a company like GE taking their kind of proprietary knowledge and their advanced technology and going into China with that? We've seen some stories lately about, U.S. companies. There was one about a wind farm in Bloomberg where they basically partnered with a Chinese technology company and then found that the Chinese company had taken their software and everything and cloned it so they could cut out the American company.
Well, indeed, the whole point of Beijing's strategy is to extract technology, and then it will go sort of viral within the Chinese economy. Once the technology is acquired, it will be shared out with other companies within China. So the whole game is to learn how to produce things more efficiently, produce better products, higher quality products, et cetera, et cetera. So Americans hitherto, particularly in the 1950s, 60s, and 70s, dominated in advanced manufacturing. And to some extent still, companies like GE have stuff that really is leading edge. And China, very naturally from a Chinese point of view, wants to have these technologies.
So do you think for American companies, this is something that's still good investment for them to go in like that?
I would make a distinction between American companies and the American national interest. Mm-hmm. From the point of view of the American national interest, this is bad news. If America doesn't have any production technologies to call its own, it will decline in the world economic pecking order. Because other countries, Germany, Japan, are much more aware of the need to have proprietary technologies that they do not let outside their country, production technologies that make their workers very advanced, very productive. America is not concentrating on that. And in the long run, as these technologies are transferred to East Asia, to other parts of the world, America loses its edge. Its trade position becomes worse and worse.
Why do you think it's not concerned about that?
I think it's ideology. I think that the prevailing ideology really goes back to the 1970s. Leading thinkers like Milton Friedman persuaded the American elite, certainly, if not the American public, that individualistic economics is the right thing, so that what's good for the individual is good for the nation. But that doesn't quite follow. That the nation depends on things like exclusive use of key technologies. At the level of the individual, corporate executives in major American corporations can maximize their executive bonuses, stock plans and so on, by giving away this technology. But in so doing, they're undercutting the American workforce.
Won't they undercut their own companies?
Absolutely. But the effect will become apparent only after they've retired and after they've secured their very large bonuses.
So from an individual effort, it doesn't really matter then?
Viewed in terms of individualistic economics, they're doing fine. But the nation, the American nation, is being, frankly, ripped off.
Do you see, I mean, I want to go to kind of the recent presidential election just briefly. You had an interesting article in Forbes where you argued that, the China Daily was giving the Judas kiss to Barack Obama by kind of talking about how, kind of mean Romney was being basically to China, but that they really wanted Romney and not Obama. Now that Obama's reelected, do you see like any kind of change in course for the U.S. and how it deals with China?
In that article, I pointed out that really for both of these candidates, a major concern is Wall Street. And Wall Street has a lot of influence in Washington. So whether it's Obama or Romney, Wall Street is very largely calling the shots. Obama, because he doesn't have to face another election, might be stronger than Romney would have been. That was the point of that article, that Obama at least doesn't have to go around raising money again. Mm-hmm. And therefore he can, to some extent, ignore the pressures he's getting from Wall Street. But many of his advisors, of course, are really tuning into the Wall Street view of things. So even for the American president, it's not that easy to change policy. So
the Wall Street view of things in terms of China is what?
To basically continue with a policy of one-sided free trade. And from a Wall Street point of view, China's where the money is. China is the number one exporter of capital in the world today, most of the time. Last year it wasn't, Germany was bigger. But most of the time, China is. And Wall Street runs on money. So if Wall Street wants to sell stuff to China, US Treasury bonds, for instance, the people in Beijing are very happy to do that, provided certain things are given in return. And one of the things would be political influence in Washington.
Okay. Well, thank you so much for joining us today, Mr. Fingleton, and giving us your analysis on this issue. And thank you for watching. For more on this and other topics in China, join us at ntd.tv.